Hey guys, welcome to the Trade Genius podcast. Bob and Phil here as always. Guys, the job numbers came in this morning. Huge fireworks in the market. They came in hot. Normally that's bearish, but the market didn't buy it. Why? Well, we're going to show you and what that means over the coming weeks. Don't miss this. Let's dive in.
Trade Genius.
Okay, Bob, so NFP numbers, at first it blew out estimates, right? And that meant that the market was bracing for more hawkish Fed because the Fed's going to have to tighten and raise rates to keep the job market cool. However, as you kind of parse through the details, the devil's always in the details, and it didn't seem so hot. Take us through it.
Yeah, I mean, at 5:30 this morning, I usually go grab coffee before the market opens. I waited for the report to come out, and, it went the wrong way, the way I was positioned for today. So as I'm driving down to the coffee shop, I'm thinking I'm going to have to go work at the coffee shop. By the end of the day today, I can buy the coffee shop. It turned out exactly how we thought it would end. It's just the beginning. I think the algos did, and you called this the other day, Phil. You said just watch out for them to try to retest this low and fail, and they're going to launch from there. And really what gave me courage, and I doubled up and tripled up after the market opened, was that Bitcoin wasn't buying it, and the oil market went green. And, the oil market would sell off if the dollar was going to stay strong and the bonds were going to go the other way. And the oil market said, we're moving up. And then next thing you know it, an hour later, it shot up. And I'm just like, okay, this is what we expected, but why? And the first chart, you bringing up the government versus private job growth. Look at this chart, guys. I mean, it makes me sick to my stomach that they're padding government jobs while the private sector is falling. Okay, this is no bueno. This is Europe, going into a coma kind of job action here. Right. So, and a lot of times, look, they're hiring jobs because a lot of people in the government are retiring too. But that's not the only chart, Phil. Let's throw up the next one. Remember all this thing about the wage inflation spiral? Ain't happening, okay? Just because UPS, Teamsters, UAW, Gavin Newsom with the wage increase are all making headline news, wage growth is collapsing. And if you want to add on the additional burden of health insurance and with inflation, less people qualifying for, the subsidies, is that you have negative wage growth. So you're going the wrong way. And this next chart here explains, I guess, the ending or what happens when that happens, Phil. Throw this one up here. Okay. Credit is collapsing. Remember yesterday we talked about bank credit collapsing. Now, personal credit is collapsing too. So we're going to eventually get sucked into a vortex here, Phil. And here's the other one. Gasoline demand is collapsing. Oil prices went down this week, but don't let that fool you. It's seasonal. Okay. And the chart I should have thrown up is one of our clients, Phil, threw the chart up showing the SPR. They're draining it even harder now. Again, they're doing everything they can to try to break this oil market during these seasonal weak periods. But, by the middle of November, oil will be going back up again. I'm going to pause here and let you get a word in edgewise, and then we want to show you the charts and where we think it's going to go next week. So, yeah. Phil, what's your view on all this?
So I think the devil is in the details on the NFP, and we don't have it up here today, but also another little tidbit of information was that a lot of the job additions were part-time workers. And if you take and factor in full-time workers, actually there was a negative growth. So you have 400,000 jobs falling off on the private sector, but you added a ton back into the government sector. And that's just not what you want to see in a healthy economy. And I think this gasoline chart is very telling because that's really your consumer demand. If the consumers are busy and everyone's busy and businesses are booming, this is not going down like this. I mean, this is a waterfall thing. So, I mean, on the upside, we're going to have nice, gas prices are going to help us out, but this is not a healthy economy, guys. So I think what we're going to see going forward is we're going to have our market gyrations. We're going to talk about that here in a second with this other chart. But what we're telling you guys, so when we're telling you guys, hey, it's going to be bullish, when we get those moments, and we've shown you guys in some of these videos, and you guys are like, oh, you're flip-flopping. We're just telling you we're going to have these short-term pops. Overall, though, the macro hasn't changed, and we're going to get into the teeth of what I think is going to be the next phase in this bear market. We had, I would say, like the soft opening of the bear market at the beginning of 2022. Some of our metrics said, yeah, this is a bear market. That came out of that in March. The metrics actually reversed. So technically the qualifications of a bear market weren't technically met. Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. However, much like in '07, you spent '07 into '08 kind of meandering around, ultimately a lower high, and then at the very tail end of '08, the trapdoor opened. I'm not saying that that's going to happen here. I think it's a different environment, but I do think overall we're going to see a similar thing play out, and primarily because of what the yield curve is doing. If you are at all having questions about what's going on, look at what's going on in the bond market. The other thing, Bob, too, you look at some of the blue chip names that are just been getting sold hard. Hershey's, McDonald's, Coca-Cola, right? Why are these things falling off a cliff? I mean, if you bring up those daily charts, they're waterfalling. Then you're seeing institutional order flows, and we're talking big money coming into the bond market. And so that now you have to step back and go, okay, what are the banks, the big institutions, how are they positioning? Well, if you're going into a recession, your stock market's going to take a hit and your bond market's going to get bid. And I think that's what we're seeing here. So all of this stuff that we're showing you guys, the gasoline chart, everything showing you that consumer demand is falling off. I mean, go back and look at the consumer credit, guys. I mean, look at this. Consumer credit actual minus 15.628 billion. The forecast, guys, was positive 11.7 billion. And the previous was 10.4 billion actual. Minus 15.62 consumer credit. Guys, that is the economy falling off a cliff. We're a consumer economy, guys, and not enough attention is being paid to this. So I think that's going to lead us into the next part of our discussion here, which is, okay, what's the stock market going to do in light of all this?
Yeah, and I'll start filling, and you can add additional commentary on it. So if you want to throw that chart up, we'll walk them through it. So I just want to point out a few things too. The way we trade is that just because Phil and I are yakking and yammering about, the economy going into the tank, we just follow the price action. And if you notice back, you see a red triangle here, and then down below is our algorithm expressing trend and momentum. And we had basically a sell signal hit where that green and yellow caterpillar looking like chart went yellow line with a red trend. And we had a sniper sell. And this was your first warning that if you are leveraged long, you needed to go ahead and to start positioning for a short move. We got a volatility stop move, and the market had a nice sell-off. Then we had a counter trend rally, okay, that went flat, and we had another sell-off, and that ended the bear started getting yesterday and Wednesday. Actually, we started getting indications that a buy was coming. We warned you that a sharp reaction move was coming, and none better than a news event like what we had today with the NFP. So today, we're already positioned long going in. That's why I just said to you, I was positioned long based on our algorithm, okay? And it played itself out because this was our expectation. The market did what we expected. And where do we go from here? Well, we passed through, and I'll let Phil talk levels, but the one thing I want to talk about is there's a gap fill up there at 438. We got a Kona buy, we got a sniper buy. Those usually have legs on it. And Phil, I'm going to turn it back to you because you can walk them through some of the levels that you see because you trade futures and I trade options. So
yeah, I mean, I agree with you on the levels as far as SPY goes. I think that gap fill happens at 438. This market is such that you could overthrow that a little bit. But I think once we're up there, you have to start looking now at if you notice that where the white line kind of levels off above where it says SPY, we could go and maybe dip a toe back into that was support, now resistance. So stuff like that. Ultimately, though, it's setting up for another leg lower, in my opinion. And the other thing we haven't really touched on in a bit is liquidity. And liquidity is going to be draining. There's no ifs, ands, or buts about that. It's going to be draining at the second half, into the second half. And this is where the issuance from Yellen matters, because the second half of the month into November and December are quite bearish for liquidity flows because they are issuing longer term debt. And the way that the market works is that longer term debt takes liquidity out of the market. They can't turn around and use long-term debt for collateral like they can with T-bills. And that's all we've been getting, guys, is T-bills ever since June. So the administration just said, let's juice the market into Q4. And that's exactly what they've been able to do. So that party's coming to an end. And I think it might coincide with us going up into that flat zone there. So maybe we got another week and a half of positivity here, guys, Bob. And then I think we roll over.
Yeah. And Phil, maybe Monday or maybe even tomorrow, we could talk about how you use the 9 EMA historically to find where the market will bang on its head here and roll down. So I think it really helps us. Look, we're just not out here just shooting darts. There's high probability events and we just follow them. So with that, it's all I have today, guys. They're constantly lying to us. And if you notice looking at this chart, we're just making series of lower highs here. So bear market has never left us, until they can start making higher highs. And these are just a series of dead cat bounces, but sometimes these cats can bounce pretty high. So Don't FOMO against this move. Let it start to fail again. We'll see it in an algorithm. We'll share it with you guys.
All right, guys. Well, that's going to do it. Let us know your thoughts on today's video. I'd love to hear from you in the comments below. Otherwise, check out our stuff over at tradegenius.co. Love to see you guys in the room. We'll see you on tomorrow's video. Take care, guys. Have a good one.
Trade Genius.